Good afternoon, everyone. It's good to be back at this conference. I have to get used to this room. I got to remember to turn both directions. Let's see if my slides appear to be up, so that's a good thing. This is actually great timing for me. I just, yesterday I was in San Francisco the last couple of days because we had our Stifel board meeting. Stifel's a public company with about 5,000 employees, and spent a lot of time with our outside directors, including our comp committee directors, and I have great appreciation for what you do and what they do. I know community bank is challenging, but how'd you like to be comp committee, dealing with those greedy investment bankers and traders, and be a bank holding company as well. And some of our outside directors were asking at dinner, I think it was Sunday night, how do we set expectations? And I kind of made a joke. I said, well, usually around this time of year, the Wall Street Journal will run some kind of article, and it's either going to cause a problem for us by raising, bonus expectations or lowering them. So I was so happy to open the Journal this morning, on page C3, it said Wall Street to see smaller bonuses. So I know that our comp committee is smiling today. And as managers, as a manager in the firm, it's always good to get expectations aligned with the bottom line. So I was happy to see that as well. I think that what I'm going to do is talk about the strategic view of what's going on in community banking, talking about what's going on the balance sheet, earnings outlook, market volatility, a little bit about M&A. And the reason I think that the bank director has me do this each year is it's almost impossible for you as outside directors or managers to make decisions about having the right people in the right seat at your banks, unless you understand the strategic context that we operate in. So I'm going to do that, and I'm also going to think a little bit about how we do that within Stifel. Ryan Beck and Stifel got together a few years ago, and we were able, and we've done some other deals, we were able to attract a group of directors with a broad degree of expertise, and they always ask incredibly insightful questions. And I was actually thinking, just before we came up, one of their questions yesterday was about, we have to use this term, regrettable terminations, the people that we've lost as a firm, because in our business, just as in your business more and more, it's all about the elevator assets, the people, and they want to know why we lost someone, to whom did we lose the person, why is it regrettable, incredibly insightful questions. And I know they have all these responsibilities. We are a bank holding company as well for compliance, the things you're wrestling with today. But I just do encourage you as first and foremost directors, and then as compliance-oriented directors, to think about those insightful questions, to ask management. Another of the questions we dealt with yesterday is what I like to call the bad apple question, and that is, we're very fortunate, we have a very strong balance sheet, we don't really have to worry about some of the leverage craziness that many of our competitors deal with, but we always worry about that one bad apple. And when you have 5,000 employees, or if you have 100 employees at your community bank, I'm sure you think about the same thing. Because I always say to myself, wow, we're doing a great job, but if we have 1/10 of 1%, bad apple, someone that's going to risk our franchise with a compliance problem or defalcation or some of the reputational issues, it's a real problem. And so as much as sometimes Washington gets us distracted as directors and managers of financial institutions, I do encourage you to come back to the strategic, come back to thinking about keeping the right people, thinking about that bad apple risk that, frankly, the regulators can never define, how you measure that, how you control that. But in the end, that's what does in so many financial institutions. Right now, I think about the distractions coming out of Washington, with Dodd-Frank compliance and Basel for the big banks and Fed policy that's driving the earnings of many community banks up through the ground because our investment portfolios aren't doing anything, while the big picture is trying to grow banks, grow both organically and through acquisitions. So that's kind of a little bit of my some of my pet peeve. I think about actually when the height of the credit crisis was happening, a lot of bad loans were being made in this country, craziness at our big investment banks. This was 05, 06. We were all focused on, AML, BSA was, the hot topic every exam, and we didn't have a whole lot of discussion. And I think now, the same thing happens every day. This week or last week at MF Global in Washington, not a systemically important bank, but in this day and time, post-Dodd-Frank, an investment bank with 30 times leverage, regulated, and no one raised their hand. So we've got to, as directors and managers, we've got to stay focused on the big stuff. So let me dive into some materials here. You do have a handout as well, but I'm going to talk first just to start with the balance sheet. I think the good news about the balance sheet is the crisis has passed. For many banks, capital levels have rebounded across the industry, and all these charts are going to separate banks over 10 billion and banks, smaller banks. I think the lighter blue are the larger banks, but TCE, tangible common equity, is coming back. Non-performings, peaked, are coming down. We got as many third quarter numbers as we possibly could in here, given the time of this talk. But non-performing assets to assets are coming down, not to pre-crisis numbers, but looking better. Charge-offs, as a percentage of average loans, coming down. Got a ways to go to get back to normalized numbers, but all the trend lines are good. Reserve coverage, these are all things 2 years ago, it was a whole different discussion. Some of you that heard me at Bank Director or here or other places, we were focused on balance sheet, credit risk, problems are under control. For most companies, obviously, there's always 5%, 10% of banks that have much more serious problems. But, market valuation remains challenging, for community banks, because although I showed you a bunch of charts to show that things were getting better, the fact is, when you think about it from a historical context, we still do have, problems. Median non-performing assets are still elevated on a historic basis, versus, some of the, back in some earlier periods, and this goes all the way back to the early 90s. And bank valuations, in the simplest way to think about it, do move, according to asset quality. The better the asset quality, the higher the valuations. And so you can see that's why the industry as a whole is trading below book value today. The other thing that's very unusual for banking right now, for the public companies in the room, this is one ugly chart. That's the volatility you're seeing among all the indexes. And I gave you the small banks, the mid-cap banks, the large banks, the S&P 500. But you can see that the market is trading off of the macroeconomic situations, not just banks. It's, every day, you go home and see the market moving by 100 or 200 points one way or the other, very much in response to, what happens to a country with 11 million people in Southern Europe, and kind of say, why should that affect, my bank? But that is a fact of life, and we just have to look through that and realize that volatility is here, and eventually that will move away. I could spend a lot of time talking. There's a lot of other factors that go into that, but you can't kind of fall for those head fakes involved in the volatility right now from a planning or compensation standpoint. Small and mid-cap banks, have outperformed the larger cap companies when you look at a relative basis. I mean, all you need to see, I might as well pick on Bank of America for a second. You can see Bank of America, telling public they don't need capital, and almost every other day they're in the paper talking about swapping preferred for common. Today was selling their portion of their franchises or selling their Chinese bank investment. The fact is, as long as the big banks, have issues on transparency or global issues or needing to raise capital, they will underperform, and they become kind of the whipping boys, for the industry as a whole. banks have, underperformed, the broader market over the last 8 years. Almost, I think there was just 3 years where they didn't. Yeah, that makes it a bit of a challenge to convince your friends and neighbors to invest in banks. It's a challenge for us to raise capital for many institutions. It's an extremely selective market. But if you just look at the S&P 500 performance and the S&L Bank Index every year, you can see the relative performance. And that's something as an industry, we have to deal with. That is, how do you project to the public, what the earnings power, of the industry is? It's not, the industry is solid, I believe, from a balance sheet standpoint, we've talked about, but it's the earnings power of the industry, that's important to communicate, going forward. Another interesting observation is what I call differentiation, between the best performers in certain categories, whether it be on capitalization, on asset quality, on size, on net interest margin and profitability. And other than in asset quality, where you see huge differentiation between those with high quality assets trade at much higher numbers than those with lower quality, there isn't all that much differentiation right now between the good banks, the highest performing, the highest quartile banks, and the broader mass. That's another factor that will change as money starts to flow back into banks. Keep in mind that the financials as a percentage of the S&P 500, which at its peak was, I think, 24–25%, is something like half of that today. As flows come back in, we'll get differentiation. Not happened yet. So when you think about those directors, so what's going to drive strategic outcomes in the future? I think it's all about defining what earnings and growth is going to be like. And I'm going to spend a minute and talk about how we come to what the new normal is going to look like. Everyone asks me the same question. When things settle down, are banks going to trade at 250% a book again? And if not that, where are they going to trade? Obviously, they're going to trade a lot higher than where they are today. But where are we going to? Because I think if you're trying to design incentives for your bank, that's kind of important. What is you can't necessarily, I believe, look back the last 10 years or 20 years to look for the benchmarks. I think you kind of have to look forward and design some new benchmarks in this post-Dodd-Frank environment, because there are a number of factors that affect the earnings power for your institution. You could have the best management team in your county, your state, your region, and they're still not going to be able to achieve results on average, versus where banks were 10 or 15 years ago. Part of that is macro, low growth. Everyone's got their own economic theory, but I do believe that we're in a long-term deleveraging in our economy, and maybe we're halfway through it. We have a ways to go, and growth drags as we go through that process. A lot of revenue pressures on banks. Everything from some limitation on fees come from the regulatory side. Impact of the new consumer agency. Operation Twist is not a good thing for banks. Community banks in particular have for decades relied on their investment portfolio as an important balance in their earnings power, as an anchor. And we all know how the investment portfolio is doing today. Very challenging. And it's important, obviously, that you incent the people running that portfolio not to take risks today. That's, in a perverse way, the Fed, in a different capacity, not as regulator, but as central bank, is encouraging risk-taking to a degree that I think we will regret as a country, 3 or 4 years from now, when we look at the impact of all the Fed activity in the private markets. There are higher costs, and higher costs will remain, whether it be regulatory compliance, deposit assessments. Larger banks, the systemically important banks, will even have other costs. Credit, reserve releases, lower provisions, helping bank earnings. Right now, that will ultimately revert to a normal level, and so growth in earnings will not come from a decrease in provision. And then I think very importantly is capital levels will be stronger. Yeah, we'll be stronger. We'll be higher in the industry. And the types of capital, will simply be tangible common equity. And that's a big difference. Community banks, as much as we want to think that there's a lot of abuses with the trust preferred portfolios, the trust preferreds for the last 15 years did provide an ability for community banks to leverage the use of their tangible common equity and generate higher ROEs. That is not coming back, in our view, and who knows if there will be other types of capital that will qualify. And so I think that's part of the new normal as well. And I think you can see it, if you can read this slide, and I'll have to put my glasses on to read this slide. If you look at the average of 97 to 2006 and look at return on average common equity, first for the top 50 bank holding companies, you can see the average was 15.6%. Right now, even though we've come out of the crisis, for the third quarter, it was about 8.6, and for the broader bank index, it was about 7%. So banks are earning about half of what they normally do. That should get better as we come out, as the economy improves. But it's not going to, in my view, go back to the same levels. And at the bottom of the page, you can see that banks, whether large banks or small banks, are trading about half of what they traded during that 2006 period on both a price to tangible book basis. We'll really look at the price to tangible book. You can see for large banks, 308 was the average, and now it's, for the third quarter, it's about 106, and for the smaller banks, about the same relationship. And I think that's principally a function of banks' ability to use their capital. Another way to think about this, kind of what will this new normal look like, again, which I think is really important as you calibrate your compensation plans going forward, is pre-crisis, typical community bank was a 6% TCE company. Now 8%, let's say, is what many companies are driving towards. Maybe you can't make 1.25 ROA anymore. Maybe you can make 1%. A more realistic goal, and you may not be there today. And then if you just arithmetic, you do the arithmetic, that means that implied return on average equity in those numbers is about 12.5%, not 20%. Growth, maybe it was 6% in the past. Right now, if we can get organic, so I'm not talking about acquisitions, we may get 2%. And when you do the math, it just works out. You do a kind of discounted cash flow model, impute a cost of capital, lower cost of capital, obviously, because rates are lower. But the implied price to tangible book for a bank with these numbers, and you can do this for your bank, is about 150%. Now, that leaves a lot of upside versus where many banks are trading today. But when people ask me the question, well, where are we going to get to? And forget M&A numbers. We'll talk about M&A in a few minutes. But on a trading basis, a bank performing at 1% with higher capital levels and lower growth is going to be 150% a book institution. I know for many of you, you'd like to see that tomorrow, and you're not there yet, but that's frankly how we hope to bring many more investors back into bank stocks, with this pretty simple, arithmetic. A couple other factors that are impacting the bottom line. I think in many respects, as it's kind of always been a struggle, is the efficiency ratio in community banks. On the lower left here, the yellow line are the banks greater than $10 billion. And you can see their costs are going up, but they continue to have a substantial advantage in terms of their efficiency ratios, which is a function of both their revenue side and their ability to spread their expenses over a bigger base. And if you think about it, you're here as directors, many of you are representing small institutions. For a big bank, they have to go through the same process, but they're spreading it over a much bigger base and translate that to technology and credit underwriting and all the other oversight functions that are so important. But it does impact the earnings power when you think about that in a slower growth situation, because in the past, banks could rely on really operating leverage to solve for a lot of that problem, that you had expenses, but you saw growth, so the ability to leverage those expenses. Right now, because of the nature of the economy it's difficult to see that operating leverage. Another factor worth mentioning is the composition of deposit bases and loan portfolios at community banks versus the largest banks. And I know some community banks are, these are averages, but there continues to be relatively high reliance on real estate in construction development lending, on average at community banks relative to the large banks. And deposit composition still, fair amount of dependency at the banks less than $10 billion on retail CDs, versus non-interest-bearing deposits or transaction accounts. And that will become a factor, not now, it doesn't matter, but when short-term rates move up, that will be an issue between smaller banks and larger banks. But as I said, I think that for the most part, the balance sheet's getting better. Banks, both large and small, as you can see on page 19 here, I've circled a few numbers, are working diligently to get their expense structures in order, in line with the slower growth economy. Expenses are coming down. Provision continues to come down, which is why you're seeing the earnings numbers. The ROAA, if you look, this is for third quarter, so just the numbers that just came out. For the larger banks, it's about 92 basis points. For the small and mid-cap banks, it's about 89. So almost about the same. Return on equity is about the same. And the question is, how we continue. Are we about done with reduction in provision, or reduction in expenses? Because at the moment, that's what's driving earnings. It's not, it's not loan growth. It's not growth, in revenues. And I think this is another positive. As I said, the banks are in general working hard to control expenses, reduce their credit cost. And on a preliminary basis, as I said, that we went to print 3 or 4 days ago, so not all the numbers were in here. This is for the, but you can see pre-tax, pre-provision return on assets, moved up nicely in the quarter, 1.42. This is pre-tax, pre-provision. But it's a way to look, kind of exclude the noise of provision moving around and looking at the earnings power, of banks across the country as directors. And I'm not saying this is something you can tell your investors that you should look at, but it's a good way to have a baseline, get rid of the noise. Let's see how we compare to our comp group on a pre-provision, pre-tax basis. I was actually very, I was surprised to see this number. I thought it was an impressive number. The yield curve has not been, the friend of institutions. I don't think anyone expected short-term rates to be where they are, to see the Fed intervening on the long end, to be purchasing mortgage-backed securities that causes a lot of problems, for net interest margin. Net interest margin was 3.69 preliminary in the third quarter. And, if you recall, back in the early 2000s, margins were much higher, when you had the kind of yield curve that we have today. But because of what's happening in the residential mortgage prepayment area and the prepayments on investment securities, very difficult for the margins to hold up. And I think that's something for you to keep in mind as well as directors. So we talked a little bit about, and I know I'm moving quickly, but my task was to give you a strategic overview of the whole bank industry in this short period of time and leave some time for questions. But I do want to talk about the other question I get most often is, when is M&A gonna really take off? Whether you're thinking to be about a buyer or part of consolidation, everybody wants to know, because in this kind of slow growth environment, which may persist for some time, the number of banks that just can't generate an adequate return on equity. And as you just saw me talking about, we're kind of in the 8s right now, which is not adequate in the long term for the banking industry. So you've got an overcapacity problem. You've got not enough banks earning their cost of capital. So there are some obvious things that are going to happen, which from a strategic standpoint, we should keep our eye on. I think that that kind of tired phrase, but if you can't measure it, you can't manage it. I think that what I wanted to say was so often, and investment bankers are guilty of this, we focus simply on the banking industry, the number of branches, et cetera. And I'd like to remind everyone that depositories, insured banks, operate in a much broader financial services industry, which continues to grow. But this chart that someone put together as of second quarter of 2011, banks and thrifts are only about 24% right now of the financial assets, in the U.S. because there's a lot of other players from money market mutual funds, the broker dealers, the GSEs, a lot of other intermediaries. And what happens with those over the next few years will have a big impact on banks and thrifts and the share of the financial services industry, that they have. And then I think, when you think about banks, depositories, I also like to remind everyone that, although we've talked about the non-branch banking phenomenon for 10 or 15 years, it seems like, I would just say it is both a friend and foe to community banks right now. I mean, it continues from a generational standpoint to be strong indications that what we need to measure is kind of all of banking, including all the shadow proliferation of virtual banks and broker-dealers operating as banks and, and effectively money market funds operating as banks. Because although the size of the pie you see at the top of this slide is a lot larger, that the total insured accounts are 9.1 trillion, in part because the federal government dramatically expanded insurance of accounts in the middle of this crisis. The number of players active in that is also substantially higher. And we kind of always fall in this trap of measuring what I have on the bottom of this page, the number of branches of banks and credit unions and thrifts, which is increased, obviously not increased as much as the overall deposits, but there are so many other providers that it is virtually impossible. Virtually impossible to measure all the other players out there. I was actually talking internally to one of our analysts. I said it'd be great to come up with some way to index all these other providers and have a way to give directors a way to measure all providers of deposit function in the U.S. And after spending a couple hours on it, I realized it's basically not a way to do it. That is the nature of the internet, that where every person's PC or computer or iPhone becomes their bank, it is infinite, the number of providers, but that is quickly where we're going. So just the takeaway from that part is when you think about incentivizing, when you think about the kind of people you have in your organization, it is important that people that are thinking about financial services generally and all the different actors that they compete with. So let me spend a few minutes just talking about the strategic response to overcapacity, this consolidation question, which I always talk about in terms of kind of a tipping point phenomenon that everyone knows that there's going to be another huge wave of consolidation in the banking industry. We know we're getting closer and closer to that tipping point when that happens, but by its nature, tipping points are not something you can predict that it's going to happen 3 months and 7 days from now. In hindsight, after it happens, we're going to all say, well, that was bloody obvious. But the fact is, and I've been doing this for 30 years, I can't tell you, when there's going to be a great wave of activity. I know all the factors that have to be in place and which ones are there and which ones aren't. Well, we can talk about it for the next few minutes. But it just, I think it's something, as you think about who you have in your organization, whether you want to grow through consolidation or you want to participate in the consolidation, it's also a way to think about what kind of athletes you need at your bank. It is, as much as investment bankers can show numbers all day long on why you should buy the company down the street, fact is, the numbers may work great, but it's still not easy to do. It's not that easy to keep the bank, the employees at your partner bank in the seat and take care of their credits and assess the risk and execute well. There are some companies in this country that have done it well. There are some that have done it incredibly poorly, including some of the biggest banks in this country. But we've come, it's also worthwhile to think about how far we've come in terms of consolidation. This is 12/31/2000 snapshot versus 6/30/2011. And you can see that for the largest banks over $1 billion, control about 83%. Control about 83% in the beginning of the decade. Today, control about 90%. In the middle, the banks between 100 million to $1 billion, which are probably most of the companies in this room, control, it's down to about 9.4%. And again, this is of the banks and thrifts. Obviously, there's a lot of other financial players out there. And another way to look at how far we've come, if you look at deposit market share concentration across the country, the top 50 banks control about 69% of all deposits. Back in, I think I have the next slide, back in 2000, they controlled 55%. So we've come a long way, in a relatively short period of time. But there is a ways to go. So let me just talk for a couple minutes because I do want to leave time, plenty of time for questions about M&A and what's going to have to come into place for this consolidation wave to really handle, to be a matter of everyday occurrences or every week occurrences, and I think organizations have to be prepared for it to happen. First of all, there are headwinds that remain. We haven't seen a protracted economic recovery, so there's still a lot of credit issues. It's very hard for a CEO or a board to feel confident to go buy another company unless you feel good about your own portfolio. That's number one. I mean, no one thinks about taking on more headaches if they feel like they're still challenged internally, and that's just a function of the economy getting better. But those lingering credit concerns are still there. The regulatory uncertainty has been a major challenge for M&A. Banks that you would normally think would be acquisitive, all it takes is have a setback, and you won't read about this in the paper, but you have a setback in a regulatory exam, whether it's with a camel rating or a compliance problem, where the regulators say, like to get your house in order first before you bring us any, something. There's a lot of that out there, and that lack of confidence means people aren't going forward with deals. The accounting has been a big challenge. Fair value accounting in terms of credit marks, that is marking to market. The loan portfolio from a credit standpoint of a company you may buy, chews up a lot of capital when you do that. When you mark someone else's portfolio down 9 or 10%, so you can sleep well at night as an acquirer, and then you have to think about, well, how do I replace that capital? And you realize your stock's trading at book value, and that capital is very expensive. That's a real challenge to deal making. So that kind of cures itself as credit marks come down, as valuations come back up. There are continued expectation challenges. I mean, I'm sure many of the people in this room as directors, you thought your bank would always, if you ever sold, you're not going to sell for a dime less than 250% of book value. And I kind of have those conversations with directors. Sometimes it's after a scotch, and I say, well, let's just do the math. If all the potential upstream players are at best going to trade at 150% of book, how is somebody going to pay 250% of book for your company and have a credit mark? Or if the cost of raising new capital is this price, how is someone going to make that number? So there are some expectations, and as directors here and elsewhere realize the earnings power of the company, and as I said earlier, maybe we're going to generate ROEs of 12% at best and not 17 or 18%. then things will get recalibrated. All that math comes into place. And so I think we've had a lot of challenges. We've seen some M&A, but there's been a fair amount of volatility. I really think that we haven't seen much yet. M&A trends, here's back to 1989, the index of activity. Surprise, surprise, there's a lot more M&A activity when prices are high. There's less when prices are low. That does seem like capitalism at work. But what we're going to find is it's all relative. We kind of need to get valuations back to close to where they should be given the new earnings power, the new normal of the banking industry, and then we'll see M&A happen across the board. Oops. The wrong way. Because what we call the secular drivers of M&A in terms of excess capacity and the challenges you have dealing with regulators, all those things are going to be there. It's what will happen is we'll get an erosion of some of the challenges I just talked about. Some people, it's funny, I was at a conference sometime in the last couple of weeks, and someone asked me, do I think that, it was the classic wishful thinking question, is pooling accounting going to come back? I was actually at our investor conference last week. And I kind of said, well, no. I mean, we do have FASB, and I don't expect them to ever go back, but that gives you a sense of people saying, boy, if we only had pooling accounting, and then we wouldn't need all this capital, and we wouldn't have credit marks. But the reality was the reality. Just as directors, dealing with the regulatory world, the reality is the reality. M&A will happen at new levels, and we'll deal with it, under this accounting regime and with the cost of capital, as it is right now. But I do think that, as you think about having the right athletes at your bank, running your bank, building it for the future, it is going to be, all about organic growth first and foremost, to the extent it's there. And then it's about having the people that understand the M&A markets, whether ultimately you want to derive value for shareholders through consolidation or be an acquirer yourself. All those seeds need to be planted. The work needs to be done. The boards need to do their what I call the M&A 360 every year, and that is, look at the upstream players, look at the downstream, potential partners, look at the merger partners sideways, understand what it's going to take for any of those situations, to come to pass. Realizing patience is a virtue because you go through that process at your strategic retreat this year, and you understand upstream, downstream, sideways. Doesn't mean it's going to happen the next year, but it will happen because those secular forces are there. So that is, I did pretty well because I left 6 minutes for questions. So I think that was pretty good, given that we had to cover the whole strategic view of banking. So I really would like to take a few questions about anything that's on your mind. Some of you who know me know I'm not bashful expressing views, even though they may not be always agreed with. Oh wait, we have a question from the audience. This is someone who's afraid to raise their hand. You didn't write this yourself, did you? No. Not you, okay. All right, well, I'll start with this one, and then then we'll do the Socratic method. If a company like Groupon can get its IPO done, and likely soon a follow-on offering, what, if anything, might that deal say about the broader M&A environment? Well, I think that, first of all, it's great to see the IPO market come to life. As you may or may not know, in this country right now is the biggest backlog of IPOs in the history of the United States. Lots and lots of companies want to go public, which is a real positive statement about our capital markets, but there's a reason they're all in the pipeline and they can't get done, and that is all this this macroeconomic volatility that I was talking about. But basically, the better the capital markets work, which is and if IPOs start working, it's a sign that the flow of funds is coming back, that volatility is reduced, that people are willing to take risk, and all that means, it also means that funds will come into banks. And much of the problem we have with bank stocks right now is a flow of funds problem. That we've had so much money come out of the banking sector, it hasn't come back in. So generally, as the risk-on trade comes back, which would be a reflection of, and the IPO market is a reflection of risk on trade. That means we'll see better valuations for banks. And if there's better valuations for banks, then there's better affordability on the part of acquirers. Acquirers can raise capital at acceptable prices, and they can buy the bank down the street. So it is positive, and we just hope we'll continue to see more. I think you will. I think, in a way, I don't want to digress too much in the IPO market, but I do spend a lot of time with our commitment committee at our firm, and we have a very substantial technology practice. So it's interesting. So much of that IPO market is driven by the private equity firms. The private equity firms, which control something like 50 to 60% of the companies, maybe more, in IPO formation right now, they've been very patient, but eventually they want to monetize. And they're going to have to bring some of their price expectations down, which will allow that activity to happen. Enough about the IPOs. Question?
Ben, I take your point that it's really hard to say when M&A starts coming back.
I said 3 months and 3 days.
What should prospective buyers and sellers be doing now to prepare to be ready for the second leg of consolidation whenever it occurs? What would you advise at the board level institutions should be doing?
Yeah, no, it's a good question, and I think, I just mentioned, in fact, I'm doing this with the board this coming Friday, that it's as part of the annual strategic review, you do what I call the M&A 360, and that is you look at who are our high quality downstream partners, who should we be looking at, what would it take for us to be able to afford them, who's our merger partners, people of quality that we respect, and what would it take to make those happen. And then on the upstream side, that is, if you're a potential seller, what do you think you're worth? What might you be worth 2 years from now, 3 years from now? And if you're worth that in your mind, who could afford to buy you? And you do that. And eventually, one of those 3 segments of review will come to pass. And I think your goal is to be ready for that when that happens. Other questions? All right, right up front here, Mike. Wait, she's running with a mic. To Mike. Mike's his name.
Thank you. When it looks like that from 2000 to 2003, the bank index was doing much better than the S&P. But since then, it has been trading pretty badly. Is there any fundamental shift or change, and is that likely to get fixed over a period of time?
Yeah, right. The question is, when banks have underperformed since early 2002, 2003, eventually that's going to change. I think right now, on a fundamental basis, banks are undervalued. That will change very quickly when the S&P portion of the S&P devoted to financials goes back up to much more normal numbers, because it will be like the tide washing through a small inlet. I mean, it will come through quickly, and they'll be looking for whatever public companies they can find, and it will drive prices up. And at that point, they'll outperform the S&P, because what happened is the reason it underperformed, S&P financials became such a big part of the S&P 500. It kind of collapsed of its own weight. And the rest of the sectors improved, but that will go the other way, absolutely. All right, if there's not any other questions, I want to thank everyone for their attention. I hope you get a lot out of this conference, and we'll see you next year.
Yeah.
Thanks.